In this next section, we will be focusing on building an investment portfolio, what's required to build a diversified portfolio, as well as understanding each element that will go into a portfolio, whether that be equities, bonds, CFDs, ETFs, and understanding the risk management side of it. Hopefully, this chapter will give you all the details you need in order to help your clients or help your prospective clients build an investment portfolio around their investment needs and objectives. Okay, building an investment portfolio involves careful consideration of a number of factors that naturally will align with your financial goals, the risk tolerance you're prepared to take, as well as your investment horizon. So there will be a key number of factors that we would want to look into. We are of the nature of building a pretty diverse portfolio, which will be spread across multiple stocks, multiple different industries, and multiple different asset classes. But when it does come to your clients, it's essential to understand first and foremost what are their investment goals. Are they looking for a short-term or a long-term approach? Are they looking for income, or are they looking for growth, or are they looking for a hybrid of all? Okay, so it's essential to first nail down, what their investment goals are, and then we can find and align it with the products we're going to look at. A risk tolerance is important. What is their risk appetite? Are they prepared to take on an extra degree of risk? Are they looking for more growth-based investments? Happy to invest in companies in the infancy stage, maybe focusing and taking on board currency risk by investing in other markets, or are they more safe? Are they looking mainly for just reliable, predictable returns? Okay, that is the most important aspect, so that you're not overly exposing your client into areas that they don't really want to be in. And when we look to diversify, it's important to understand asset allocation. Okay, we are of the nature of building a portfolio which comprises of, stocks, bonds, ETFs. That tends to encompass an array of asset classes. But is a client purely just focused on long-term equities? Are they not looking for a balanced approach? These are things that you would want to consider. And then looking at the time horizon is important. Are your clients happy to be locked in for a long duration of time? Are they targeting certain milestones? Maybe the fact that their kids will have to go to university, so they would want to have some capital for then. Are they looking for retirement planning? So it's important to understand the investment duration, as certain asset classes will impact that. Bonds in particular are very long term, especially if you buy long dated gilts, for example. Or if, for example, you buy individual stocks, they can be easily bought and sold. So, life stages is important. Are they young professionals? Are they nearing retirement? It's always important to understand that. That will go hand in hand with their liquidity needs. Are they looking to be in and out of positions quickly? Or do they want to be very much cash ready? Or are they happy to invest their current liquidity into long-term investments? So when it comes to building a portfolio, these are the considerations you want to be taking into account when speaking to your clients, and that's going to help you ascertain what your company offers and how that can marry up with their objectives. If they are looking for something, more long term, you may want to focus more on equities. Is it the fact that they're focusing much more on retirement, less prepared to take risks? So you may want to be predominantly in the 250, in the FTSE 100. But you will have investors which are open to taking on a certain degree of risk. It could be more adventurous than others. So you may want to open up more smaller cap stocks. It may not take up the bulk of their portfolio, but these are areas you would want to look at. Okay, it's all about building a balanced approach, which we believe, and a portfolio should, at times, and this will vary. This is just purely a blueprint of how we operate. But a portfolio should have at least 20 to 25 stocks in order to really be considered balanced. And look, that's very everyone will have a different view on that. Okay, so this is not, in essence, bulletproof. Um, but it is true when we say, not too much capital should be dedicated in one individual stock. If you look at a lot of investment trusts, for example, there are restrictions on how many stocks a portfolio, or how much a trust can have, and how much capital can be dedicated towards each stock within a trust. So you should treat it the same way as when you're building investment portfolios, not to overinvest in certain stocks. Try having an even balance, again, spread across multiple sectors. So, in order for it to be truly, balanced, you should be having exposure across, different markets, UK, US, and Asia. As we know, within the US and Asia, there are time constraints, but having index trackers will allow you to have that form of exposure. You can have high yielding ETFs, for example, in the S&P, which target top dividend paying companies. Um, and again, you should try focusing on multiple different asset classes, stocks, bonds, ETFs. That's the best way to build an overall portfolio for an investor. And, it tends to ride many sort of market conditions, rather than being too directional and then being caught out if the market does go against you. What I've done here is I've put together a little chart, something that we've used for a number of years, in order to um, give you a picture of what a balanced portfolio may look like. Let's say hypothetically an investor has £100,000 to invest. Ideally, for an average investor, 70% would be invested in income and growth, 20% would be in speculation, and 10% is usually into diversification areas which are not used by many investors. It's just a way of spreading risk outside of your traditional form of investments. And so when we talk about income and growth, we're talking predominantly about bonds and equities. Bonds in a primary market are going to be difficult to obtain, due to the auction prices being considerably higher. And second of all, you can get access to bonds via the secondary market and through ETFs if you did choose to. They normally tend to be medium to long-term investments. So it's not something you're looking to day trade, weekly trade, monthly trade. You're there to lock away the capital for the medium to long term. They tend to be low to medium risk. Low would be more associated with bonds. Medium risk is always now associated with equities. So that is a time frame you're looking at. Your main aim within income and growth is within its name. You're looking for that dividend and that potential growth. And when we say income and growth, equities can be spread across, the FTSE 100 as well as 250, and even slightly lower if need be. Now, when we talk about the speculative nature of investing, that tends to be more around the currencies and the contract for difference, the CFD element. It is a short-term horizon. You are carrying that higher degree of risk. People invest within speculative products, maybe as a hedge to take advantage of short-term fluctuations in the market. So that tends to be one of the core reasons. It never really becomes the bulk of an investor's portfolio, unless they're really prepared to assume a huge degree of risk, which is not really advisable. But again, it will be down to individual preferences. And the final part would be to diversify. 10% of our capital is in here. I've put exchange traded funds because exchange traded funds do allow you to diversify across different markets, different investment products. So you can have ETFs which focus on commodities, currencies, US equities, emerging markets. There's even like marijuana based ETFs or small cap ETFs. So it's very varied. And it actually does assume a medium to high risk tempo. You can have passive based ETFs which mimic the market, but then you can have more actively managed ETFs such as ARK Innovations, which focus very much on innovative small cap companies. It does assume a huge higher degree of risk. So it's always best just to keep this sort of structure in mind when you are speaking to clients, as this will help you put them into the right sort of bracket. But in general, everyone should have this form of structure at least to their investment portfolio. Now we'll delve into the types of investors that are going to be out there. And the first two sections are going to be the individuals that you're more than likely going to be speaking to. But it's important to also understand what institutional investors look like, as well as international investors. It's important to understand, what is their main drivers and what are their characteristics. So when it comes to retail investors, these are the traditional investors. You and I, at the end of the day, we could have, a long-term focus. We could have a medium-term focus. We are there prepared to buy and hold. The backgrounds will be very diverse. A lot of the people you will be speaking to may be of retirement age, approaching retirement age, but also maybe, young investors which are looking to get involved. So you've got to cater towards what their investment needs are at the time as well, moving forward. And retail investors, they make their own decisions at the end of the day. They rely on what advice they're getting, and they are very big into diversifying investment portfolios. But when we look at traders, these individuals will have a short-term focus. They're more active when it comes to the day-to-day activities of trading. Okay, whilst with traditional retail investors, long-term investors, they're more passive. They're happy to leave it there. But day traders or traders in general will have more of an active approach. They are very much technical focused, so technical analysis will make a bulk of their decision making. Okay, so they'll rely very much on charts and signals at times. And they do have a very high risk tolerance, and they are prepared to take losses if need be. When it comes to institutional investors, these are the big banks, pension funds, hedge funds. They naturally have a large capital base. Their focus is predominantly for the long term, and they do naturally have a professional team, and that will help obviously acquire the stocks that they may need. And they do have a huge market influence. A lot of developed economies such as the US, Europe, and the UK is very much institutional led. So if they are to make big purchases or sell off quite rapidly, it will have a big impact on the overall market. And then finally, we got the international investors. They're focusing very much on diversifying across multiple different time zones. They are exposed to more currency risk, but they are prepared for that. They do take advantage of global trends, especially if the market is rallying, not only in the UK, if they see the US is actually outperforming. The FTSE took a lot longer to hit its all-time high than it did, for example, in the US. S&P and Dow were hitting all-time highs a couple of months back. So it is a case of there are certain markets which are propelling, so they do take advantage of global trends. Risk management is a big focus of not only international investors, but also traders as a whole. Okay, but we're saying that risk management is a focus of every individual that you see on this screen. But these are your traditional sort of investments and the major players when it comes to buying and selling stocks and other forms of securities and asset classes. We just want to focus very quickly on two different types of approaches when it comes to investing. You will always have the active side, and then you will have the passive side. You will have dedicated investment products that are actively and passively managed, ETFs being an example. You will have investment trust, real estate investment trust, any other form of packaged products. They do have tendencies to be actively and passively managed. It's not black and white. You do also have hybrid options, which do encompass elements of both. So it's important to really understand what you're looking for. When we talk about active management, this approach naturally will come with higher costs if you're consistently in and out of positions on a daily, weekly, monthly basis, or if you do have a fund which is actively managed, that the management fees and the taxes will tend to be a lot higher than on a passive side. There is a potentially higher returns because you're not there looking to mimic a benchmark or mimic an index. You're there to outperform the overall index. And so by having an active approach, you are in and out on a regular basis and potentially taking better advantage of trends and movements in the market. Time frames tend to be not necessarily time frames, but the time and effort is a lot more. You are a lot more glued on to what's currently happening in the markets. So, it does require a lot more energy than a passive investment. So when we talk about the other side of the coin, which is passive investment, a lot of this will involve index tracking. You're there predominantly just to mimic the returns of the benchmark, which may be the FTSE 100, the S&P. You're not necessarily there to outperform it. You're happy just to lock your money away. And if you are happy with the 5-6% returns yearly that the overall index is providing, then you're all good. And due to the fact that you're not actively in and out of positions on a very regular basis, the actual risks are a lot lower and the costs are a lot lower as well. The passive funds or passive investment tends to involve a lot of low beta companies, which will mimic the market. And as you're not in and out of positions on a regular basis, costs will be a lot lower. So those are the two distinct variations of investment types. Of course, you will have the hybrid approach as well. So it depends which way your clients want to look at it. Are your clients prepared to mimic the market and, in essence, track the performance? Is that all they look for? You may want to look at low beta companies. You may want to look at stocks which are cyclical in nature and very similar to what the index is doing. But if you do have an investor that's very bullish on the overall market, you believe the market will rally, you want stocks that are going to outperform that. Try targeting high beta sectors, and that will potentially achieve your objective. So just understand both elements and see which one marries up best with your prospect or your client.